Hello, savvy investors and real estate enthusiasts. Welcome back to Investing Iguana, the channel where we dissect the complexities of the market and make investing more accessible to you. I'm Iggy, and today we're diving into a topic that's been hot on the lips of every Singaporean investor, the recent share price slide of Mapletree Pan Asia Commercial Trust, also known as MPACT. The Investing Iguana is featured and ranked 8th in the 2023 Influential Tigers by Tiger Brokers. In the bustling realm of Singapore's real estate investment trusts, REITs, Mapletree Pan Asia Commercial Trust, MPACT, has recently unveiled its financial performance for the third quarter of the fiscal year 2023/2024, ending December 2023. In a surprising twist, the distribution per unit, DPU, took a slight dip to 2.20 Singapore cents from the previous year's 2.42 cents. This downturn has nudged MPACT's 9-month DPU down by 10.1% year-on-year, sparking curiosity and a bit of concern among investors. Why has this once stalwart of the Singapore REIT sector seen a dip in its share price, despite a seemingly solid performance? Buckle up as we explore the real story behind MPACT's financial performance, what led to the dip, and what this means for investors like you. Stay tuned as we uncover the layers behind the numbers and what the future holds for MPACT. Following the announcement of its earnings, MPACT's share price experienced a brief surge of optimism. The price peaked at $1.46, reflecting a positive reaction from the market. Investors, buoyed by the company's performance, drove the price up in anticipation of continued growth and profitability. However, this surge was ephemeral, and the price soon wobbled back down to $1.39 by the 9th of February, 2024. This fluctuation in MPACT's share price is not uncommon in the stock market. Prices are influenced by a myriad of factors, including the company's earnings, economic indicators, and market sentiment. In this case, the initial optimism was likely driven by MPACT's earnings announcement, which often provides investors with a snapshot of the company's financial health. However, the subsequent drop in price suggests that investors may have reassessed their initial reactions. Perhaps they took a closer look at the earnings report and found some areas of concern, or maybe broader market trends influenced their decision to sell. Regardless of the reason, the drop in price serves as a reminder of the volatility inherent in the stock market. Let's delve into the heart of the matter. The squeeze on distributions, a key concern for investors, was largely due to an increase in financial costs. These costs, which include interest payments on loans and other financial obligations, surged by 14.1%. This surge was primarily driven by rising interest rates, a global economic phenomenon that has a direct impact on the cost of borrowing. When interest rates rise, the cost of borrowing increases. This means that companies have to pay more to service their debts, which can put a squeeze on their profits. In this case, the rising interest rates nudged up the cost of borrowing for the company, leading to higher financial costs. Despite this financial hurdle, the company's net property income, NPI, a key measure of a real estate company's operating performance, managed to record a modest increase of 1.7% year-over-year. This growth was largely thanks to the strong performance of the company's operations in Singapore, as well as resilient earnings from Hong Kong and Japan. The strong performance in these markets helped to offset the impact of rising financial costs, allowing the company to maintain a positive growth trajectory. This demonstrates the company's ability to navigate economic challenges and deliver solid results, a testament to its strategic acumen and operational efficiency. The occupancy rates across MPACT's portfolio have shown a positive trend, rising to 96.7% from 96.3%. This increase is a clear indication of the trust's operational efficiency and its ability to attract and retain tenants. The full backfilling of M Tower, bringing its occupancy rate to an impressive 98.6%, and Festival Walk maintaining its 100% occupancy, are noteworthy achievements that highlight the trust's successful management strategies. However, there's another aspect that requires attention: the leverage ratio. The leverage ratio, a measure of the company's debt relative to its equity, has slightly increased to 40.8%, just above the previous figure of 40.7%. This increase might seem small, but in the world of finance, even small changes can have significant implications. In response to this, MPACT has taken strategic steps to mitigate the impact of rising interest rates, which can increase the cost of borrowing and thus affect the leverage ratio. One such step is swapping more of their Hong Kong dollar, HKD, loans into Chinese yuan, CNH. This could potentially offer more favorable interest rates, thereby reducing the cost of borrowing. Additionally, MPACT has increased the proportion of fixed-rate debt from 79.9% to 85.0%. Fixed-rate debt has the advantage of providing certainty about future payments, as the interest rate remains constant over the life of the loan. This can be particularly beneficial in a rising interest rate environment, as it shields the borrower from increasing costs. MPACT, with its current dividend yield around the appealing figure of 6.5%, has positioned itself as a compelling option for investors who are exploring opportunities in the real estate investment trust (REIT) sector. The dividend yield is a financial ratio that shows how much a company returns to its shareholders in the form of dividends. A yield of 6.5% is considered attractive, indicating that MPACT is potentially a profitable investment. Analysts, who study market trends and use that information to predict future performance, also maintain a cautiously optimistic outlook for MPACT. They have set an average share price target at $1.62. This target price is a projection of what analysts believe the stock will be worth at a specific future date. The projected price of $1.62 suggests a potential uplift of 17% from the current share price. This means that if the company performs well and meets analysts' expectations, investors could see a significant return on their investment. However, it's important to note that these are projections and actual results may vary. Market conditions, economic factors, and company performance can all impact the actual share price. Therefore, while the outlook for MPACT is positive, investors should do their own research and consider their own financial goals and risk tolerance before making an investment decision. Investing in the stock market always carries risk, and it's important to make informed decisions. And there you have it, folks, a comprehensive breakdown of Mapletree Pan Asia Commercial Trust's recent financial journey and the reasons behind its share price movement. From the impact of higher financing costs to the strategies MPACT is employing to navigate these turbulent times, we've covered it all. If this deep dive has helped you gain a better understanding of MPACT's situation or sparked further interest in the REIT sector, why not give this video a thumbs up? Your support encourages us to keep bringing you detailed analyses and insights into the investment world. Don't forget to subscribe to Investing Iguana for more in-depth looks into your favorite stocks and investment trends. Have thoughts, questions, or topics you'd like us to cover next? Drop a comment below. We're all about growing together in our investment journey. Until next time, stay informed, invest wisely, and see you in the next video.